Hello guys, welcome to the YouTube Business Channel Investment. This is the first video of a long series of podcasts, webinars and investor interviews. And today, we are pleased to introduce you for our first interview, Mr. Giampaolo Parigi. Giampaolo is an investment banker, venture capitalist, and represents also his own family office, Parigi Family Office. Giampaolo developed a great experience in fundraising to help startups to raise funds, but also in conferences with family office all over the world. So please stay tuned because you're going to learn a lot of things. But before, please don't forget to subscribe to our channel and see you right after our video introduction. Hi, everybody. This is Hugo from Business Channel Investment. We have the great pleasure today to welcome Giampaolo Parigi from the Parigi Family Office. And we're going to discuss about his experience, his relationship with the startups also, and how the advice he can give, how to raise funds, and how maybe he's managing his portfolio with startups. And also we're going to discuss about the financial situation and of course the COVID and all this ecosystem, financial ecosystem also have an impact in the business itself. Thank you for coming and being here.
Thank you for inviting me. Thank you for inviting me, Hugo.
My pleasure.
Good day, everyone.
So if you could, for the community, investor community, just make a brief, 5-minute brief introduction of who you are, what you're doing, where you're coming from.
Sure. My name is Giampaolo Parigi. I'm an investment banker, board member of various companies, venture capitalist. I've been an investor and a serial entrepreneur all my life. I lived in Europe. That's where I grew up in Italy. Then I moved to Germany, the Netherlands, and then I moved to the US, where I spent over 10 years of my life and professional career. Then I returned back to Europe and living between Italy, Switzerland, France, and now back to London. I have been working a lot on developed economies and emerging markets alike. So the two things have been going in parallel in my career, and it's been a fascinating experience and exercise to have to reconcile those two way back very different world and to reconcile them, because as an investor I needed and I was striving and I was longing to get deals that were market compliance, capital markets compliance. So obviously working on emerging markets posed a number of threats, challenges, and the equations that we had to work on to arrive at the objectives that we intended to have, which is, basically exiting at the same EBITDA multiples that we would have achieved in, let's say, the Western world, or anyway, the most advanced economies.
Okay. I was really impressed by your profile in LinkedIn, and I saw you were solicited and involved in some family office conferences, and you got a really interesting TV channel interviews for many subjects in terms of investment in itself, but also from startup and economic analysis. Would you mind to discuss about that, just your feedback and experience and what you learn about that?
Well, I mean, I get invited regularly on the circuit, what with the family office network around the world. The fact that my family actually started merchant banking over 600 years ago. And but again, that per se doesn't mean anything, because backtracking in finance is never really such an intelligent exercise. But obviously, there's a certain network that is pre-existent even to my arriving in the arena, and that of course I've been developing and growing, working in 5 continents, and single family offices are a pretty tight-knit community, and the fact that they tend to adhere to strict parameters. They not necessarily looking for advertising or publicity for their deals. They tend to invest mostly alone, and in recent decades they have been, of course, more open towards aligning others with their investments. But the mandate is to manage family patrimonies and not clients' assets. Multifamily offices are something which I consider a little bit different, because basically they are more organized consulting companies. But single family offices, they're not consulting and not providing advice to anyone. They just provide advice internally to the family, and they decide and execute the investment strategies of a single familiar nucleus, larger as that may be. So, I mean, of course, having worked and having a track record in different continents across different industries has opened up a lot of doors when it comes, of course, to meeting other fellow single family officers and discussing about and sharing experiences. And that's why, I would say the regular invites I received to speak at conferences on those topics around the world, and not only about single family offices, also of course of international industrialist associations, or even leading universities and media companies. Of course, everybody's trying to share portions of expertise and to listen to from other colleagues and whoever has practiced to a good degree their trade. So I think it's pretty normal, and we live in a say mediatic world. So obviously, if you can use it and share your accumulated experience, I think it's also very good, because you can promote, I would say, a certain awareness on transactions and how to mitigate risks, avoid certain pitfalls. So it's also quite positive for the industry as a whole.
This is interesting. I just want to get back to this very specific point. You explained to us in some details the family office, not processes, but how it works in funders who want to knock at the door of the family to raise funds. And most of the time, people doesn't know how to make the difference between a VC and family office. And the approach, I might say, should be or is different. Would you maybe explain to us, for you in some bullet points, what's the main difference between a VC, venture capital, and a family office, and why the approach from a project standpoint, startup standpoint, should be different?
Yeah, well, they all belong, private equity, venture capital, business angels, single family office, multifamily offices. They all belong to the same broad category of alternative risk investors, as opposed to the traditional banking world. So I would say that per se, there's not a particular difference between a private equity specialist, a venture capitalist, or a single family office executive. What it's different is the methodology or the investment philosophy that they will adopt in their individual organizations. But I think all of them are, and all of us, I've been wearing those three different hats in my career as a single family office, the private equity specialist, an investment banker, and venture capitalist, actually even four, if you want to combine it. At the end of the day, you are an investor, and you will have to live with a certain modicum of risk, and the trick is to make that risk tameable, manageable, and to reduce it at terms that you can live with and make you feel comfortable. So in terms of the category, this is what I would say. In terms of the prospective companies, prospective capital searchers, on their quest, they may have some difficulties gauging against those different subcategories of a broader group, which is the risk capital. And I think this is because, of course, the business models, investment policies, even the philosophies, the angle of attack of a single organization is always different to most other organizations, even in the same line of business. So from a perspective of somebody that has to raise capital, there are certain subtleties that need to be taken into consideration. I would say that in general, but it's just a rule of thumb, a VC firm might be more open to receive unsolicited queries than single family office or multifamily office would. Because again, a single family office mandate is to manage a family business and assets. It is not bound by an investment period or a divestment period, or if it is, let me rephrase it, if it is, this is not as carved in stone as it is for the investment fund industry, where the investment period is really quite well characterized. It's normally 4 years in, 4 years in which you have to divest out, and maybe with an extension of 1 or 2 years, and it's a little bit longer if it's real estate. It goes to 10, 12 years rather than the typical 8 of private equity. So single family offices are not bound by any of these legacy models. They can invest, they can not invest, they opt in or out of whatever they do. They can change on a stamp because they are managing their own portfolios and their own capital. So when you put this into the context of someone who's raising capital, you could see how there could be some misalignment of perceptions and expectations, and we still smile sometimes in the industry as people, when we listen to people that are coming to family offices and pretending to get an answers, where in fact they might not get answers from most of these family offices, because they're not open for the public. You just don't walk in and present your case. And even if you have a beautiful venture with fantastic ratios and potential, well, it's not necessarily meant for single family office to take care of it, because again, it might be absolutely foreign to them in terms of interest, industry, even the desire to line up with a certain group of founders may or may not be there. So it's totally subjective. In the German part of in the German-speaking part of Europe, they say money knows money, and it's as I say, it's a tight community. Normally, doesn't really need a lot of additional dry power, and so the reality is it tends to cook its own business and present its own plates on its own tables as it sees fit. It's totally unrelated to the markets. It doesn't really correlate a lot with the markets. There's a lot of alpha in single family offices and very little beta. And again, when people are approaching the fundraising and capital raising, and now like everybody is used to contact people with a, I would say, quantitative approach. Well, that approach doesn't work really well with single family offices. When you have to go way more granular, you really have to know the people. You could call, of course, for example, our single family office would answer just about everybody. Of course, we might take some time to do that, just because, again, we're not only under no obligation to do so, but also because we have other things to do. And we're not out to solicit, companies to send us their request as an investment fund would do, because an investment fund needs to deploy capital within a certain time frame, and of course it's sitting on a time bomb. We don't. We may have other concerns and other issues, because of course what applies to capital, it's always valid under any circumstance in every geography and every time zone. But of course, as I say, the mandates are much wider, more flexible, and not so strict as when you manage third-party money. I don't know if I'm answering your question, but I'm trying to give you the perspective of both the serial entrepreneurs that are looking for capital, or even the smaller or larger companies that are looking for capital, and of course, the attitude of those who sit in the cockpits of the single family offices and have their own flight plan to tend to, and their own waypoints to look at, and their own timetable to comply with, which is, as I say, not necessarily correlated with what the market is doing, thinking, feeling, or wanting.
Yeah. And it's amazing what you're saying, because the perception we have in terms of, let's say, entrepreneur, startups, it's easy to talk about understand how it works. They know they don't. But when you talk about family office, it's like smoke. It's like gray sky. The people doesn't have any information. How can we approach them? We know they have the money, and it's always kind of resistance, not only from the family office side, but also from the project side, because they don't know what to do. They have no knowledge about that at all. And because it's family office is kind of secret. And you're right, because it's not the first time I feel that it's difficult to get information. They like to be in their own ecosystem. They like to do their own money. And I don't see a lot of, I might say, family office talking about themselves, like the VC are doing. Say we are doing a lot of things proud to show off, right? It's more discreet. It's still professional. Am I wrong?
Yes.
Still professional, but it's more discreet. And for this brings me another question, because it's part of the blockchain. The blockchain, we got a huge hit from blockchain for the last 3 years, with up and down. There's a lot of discussions about the crypto market in itself, the scam, the low quality of project too. But what's your perception in terms of family office, and maybe the feedback you have from your network? What do they think about that? Do they really attracted, or just waiting for invest, or is no matter what they don't want to hear about that? Because we know, if we're taking for JP Morgan, for instance, they said we don't want to hear about that. But now we have the JP coin, right? And we have the SEC, Security Exchange Commission. They're struggling a lot to implement narrow rules, but they have no idea how to do it. Only maybe maybe the feedback of your network, if we can know what they think about that and what their reaction, and if they really want to invest, and if yes, how they can mitigate the risk.
Yeah, Hugo, there was some very bad static on the line. I don't know if,
Okay.
well, I heard you. I don't know if the audience had it or not, but I got most of your comment and question on this, and I'll try to address it.
Okay.
And of course, I mean, this is a real individual answer, because I cannot see that there is a communal trend on what family offices are doing and when it comes to blockchain. And I would say that I see family offices like our family office that is interested in technology, would invest in technology, even in startups. We have a great interest in blockchain, but we believe blockchain is a means to an end. So I think there's a lot of potential applications related to blockchains, and that's where we have our interest. On the other hand, you see that how a single family office gets be attracted to blockchain and digital currencies, I think depends a lot on the type of people that they have at the helm. If they have maybe younger people, they might have and this is only in general terms, please bear with me, probably a single family office with younger generations like millennials, they might have a better knowledge and a more, I would say, even a keener attitude towards anything that is, crypto, digital anyway, and technology based, versus some of the single family offices, particularly in certain parts of Asia and Europe, where especially if the owners and the managers are very old, they might be completely have missed the train, so they're out of it. But I've seen also a lot of nuances in this, so it's really difficult to generalize. I've seen even single family offices run by elderly people who are quite well versed on technology and quite proactive on blockchain and on cryptocurrencies. And I've seen a younger officers in other organizations not being really interested into the sector. So I think that there's all the colors of the rainbow. And what I could say, it's unfortunately, the crypto space has attracted a lot of very naive people, for lack of a better terms, that thought that just by creating a cryptocurrency, they could have the business of their lifetime. And as they nearly all have discovered, unless also you have a valuable proposition coming with that, you didn't accomplish a lot. Of course, there are a few positive examples, but I think what we and we have to take into consideration the fact that not only the SEC, but also all the regulators in the most advanced country, let's say in the G20 and the OECD countries, have finally come to the realization that the regulators have come to the realization already for quite some time that those are securities and they need to be treated as such. And in turn, this can create some difficulties to those who operate in those markets. But I think in the longer run, it would be there would be greater comfort for the investors and the conditions for the markets to develop at full steam. So I think the regulations in this respect are not bad. Of course, regulations stifle innovation. This is part and parcel with everything that we tend to regulate in our life, not only in finance, but in every sector. But of course, we have also seen the damages and the disasters created by widely unregulated industries. And if you think about the aviation industry 30 years ago, 25 years ago in the US, and some of the traffic disasters that happen and with aircrafts back then, you want to have as I say, degree of regulations in place when the life of the citizens and also the assets of the citizens are exposed. So I don't think it's an issue whether or not we should debate whether regulation is good. I think we should have, of course, lean and trim regulatory functions and prescriptions. And at the end of the day, we also have players that enter the industry with clearer and cleaner game plans, and just make a buck and make a sort of a hit and run. It has proven not very viable for some thousands of those entrepreneurs that tried to do something that was not really accomplishable. And I think the market will punish you even before the regulators do, because the reality is, if you cannot create a community around the digital currency, you have nothing. So the reality is how to create a community, and creating a community is not something that happens overnight. You have to have a very strong vision, and because a platform depends on the vision, I think, at the end of the day. So you have to have a strong vision. The vision can create the condition for the platform, and the platform would trigger the interest of would-be participants to join the platform and trade and do whatever the platform allows them to do. But without the vision first, I think there's a lot of question marks that remain. And but I think the market is taking heed, and it's I'm seeing newer generations are coming with better game plans. And as I say, of course, they are looking at the longer term, as not just to make a quick buck today and then run away. So they have to build. The reality is they have to build companies like in the old brick and mortar economy. You have to build a factory. It takes time, and it takes a lot of effort and a lot of resources, not only hard capital, but also intellectual capital, and good use of the media, lobbying, and moving and shaking and steering, within the boundaries of law and reason, of course. But it's an effort that will weed out the good from the chaff, those that want to go through the eye of the needle and those who don't. And the only ones who will survive are the ones that have gone through the eye of the needle. That's how I see it.
So you just recall us that I would say, old rules of business remain. It's always the same.
Yeah, the old fundamentals apply, and there are new fundamentals that we're bringing into the equation with every passing year, for sure. But still, I think you know that cash is king. I think it's undebatable. You know, whether you're in brick and mortars or technology, cash is king, and you end up in a cash flow crisis. You know, in the 19th century, just as quickly as you can end up in the 21st century in a crisis. What I find odd, if you allow me to elaborate a little bit
sure.
on the point, is that to a trained investor's eye, to see that technology companies nowadays, especially startups, that are created by people that are very talented and that sometimes have gotten out of very good universities, but these companies are still organized in a fashion which resembles more the last millennium than the present millennium we're living in. I think this is it's an odd fascination, but I think also it creates the condition, it's inviting disaster, basically, because I think companies in the 21st century have to be totally different than what they used to be in terms of organizational structure in the past. And I still find a lot of these companies that are pitching us, presenting their decks and their executive summaries and their business plan, their vision even, and the grand vision, I find most of them still very antiquated, very old. And this clashes with the fact that they are promoting and developing very innovative products and technologies. And there is a lack of reconciliation of these two aspects. And this is one of the main causes for their failure to raise capital, I think. And nobody really speaks about it. But I'm beginning to be very vocal about it because I think, you know, we need to raise the level of awareness in the industry, startup levels, that it's not only just producing a good business plan and go about, you know, beating the bushes and trying to get the money somehow from the usual addresses, be they Sand Hill Road in Palo Alto, or, you know, the single family offices in Europe or Asia, or the multinational companies around the world. Now, I think you have to really, as a startup entrepreneur, ask yourself a number of different questions that are compatible with the century we're living in. And this has nothing to do with the contingent situation of COVID-19 or anything like this. This was always what was also there before the COVID. If anything, the COVID-19 will only exacerbate those issues and make them worse for the entrepreneurs to deal with, because obviously we're now upping the ante, and the post-COVID-19 world is going to be a world, an economy in which the companies are more expensive because of the different parameters that they have to work by. Think about labor safety or protection of the consumers in different manners. So every company will become more expensive to run. Every company will become more expensive to acquire. And so there will be technology to a degree can offer, I would say, an honorable compromise to wash out some of these downsides that we have as a legacy of the COVID-19. But I think if it is not played well, technology can become a hindrance and even aggravate the situation of certain companies that are not using technology in the optimal manner that technology desires to be used, if you allow me the expression. And there's always a leaner way to use it. And so I think that where I see a lot of oddity in the market is the fact that, you know, entrepreneurs are not there. they have studied in business schools whose models are antiquated, whose systems have been sold as state of the art, but they used to be state of the art maybe up to the 20th century, but for sure now they're no longer applicable, or in part they are no longer applicable. And companies are having a hard time coping with the new reality. And when you put also this additional measure of uncertainty caused by, it could be a trade war, it could be a tsunami, an earthquake, a nuclear disaster, or a new virus, you see that it all piles up and tends to spiral out of control. Companies are really between a rock and a hard spot at the moment, especially startups. So, but I think, there's also a silver lining, and I think this offers great opportunities for self-analysis, reconsidering a lot of options, going back to the drawing board before rushing out to us investors, because too many companies have got the itch to go to the market too soon when their homeworks haven't been completed and done properly. And I think by doing so, they miss an incredible chance, because sit in front of investors, it's a one in a lifetime type of chance, and nobody should burn it. But a lot of companies burn it just because of their unpreparedness. And I think, doing their homeworks right is what it's called on them at the moment to overcome the competition of other raising capitals, of course, and to stick out and to be noticed.
Yeah, I think it's a really interesting point, because the experience I have with a startup, it's all about that. The thing is, there is a disconnection with the ecosystem in itself. I mean, the global world around, right? They are really hurry, right, to raise funds, and there is no MVP, or the MVP is 80% done and they don't have any traction. So they can close the loop with the product, and it's still in the vision, and even sometimes the vision is not clear. So, and we are in the codiv, and sometimes, and I'm not sure if you can confirm this to me, but most of the time the startup came into me, when they came to me, say, we are unique. And when I do my research, there is two things I see. First, differentiator is wrong, it's not complete, and they are not alone. So I found it really frustrating, because for me, my standpoint, and you can interrupt me, but you need to master not only your numbers, you need to master your industry. You need to master your industry and where your industry is going. So it's not only creator, you need to, as you just said, I think, if I understand, the awareness of the market, and to integrate the new technology with the product in a specific point. If it's too soon, it's like, I might say, one shot. It's a one-shot kill with the investor. It knock at the door, the investor say, no, you're too soon, and the investor had maybe a bad idea on you. So you need a question of timing. Absolutely. What do you think about that? Because
that you're absolutely right on this item, and I think entrepreneurs have to combine the capability of delivering innovation with the demonstration that they understand what their role is within the context of their own industry. And if they don't detect the signals, because they don't read the signs of where their own industry is going, obviously they not only miss an opportunity of developing to its fullest potential their own companies, but also for sure they don't get the capital, or let's rephrase it, they don't get the best capital that they could get for the good that their innovation can bring to the market. Because, $1 million coming from a party A doesn't really mean that it's just as good as $1 million coming from party B. One type of capital can be, and I'm talking about legitimate capital, of course, let alone borderline capital or anything like that. But, even among the various forms of legitimate capital, there is capital that is more patient, that understand more your desire to grow international, that can accompany on your going international. And I could continue elaborating on this topic for hours on end. So, I mean, there's a lot of nuances that we must remember when we raise capital. And I think really what you just said resonates for sure with me and with most of the investors I know. There's a lot of these people, of the founders, are not demonstrating that they are understanding their position. I would say really the location as a GPS position, really, the coordinates on the grid in which they are operating and on which particular point on the grid they are at any given moment. And of course, without this ability, and you want to be a skipper, but you have to think where is going to be the funder that is going to finance my sailing expedition to the Americas if I, as a navigator, don't even understand where I am on the map at any given moment. And I have to be able to calculate the point of the ship at any given moment, because that's what defines the sailor and the navigator. And for the records, the only navigators alive are the navigators that are conscientious enough to know this. Everybody else perish and fail. So, there's not two categories of navigators, two categories of pilots. There's only one. The only one is the one that stays alive.
Yeah. Giampaolo, we went already over the 30 minutes, but I knew it because it's this discussion with you, it's a proof of your experience and your skills, exactly what I expected. And it's not possible to follow a frame or of process because it's so rich, When we discuss about some point, we know we want to know more, and we are trained to cover the global ecosystem. It's not impossible. So we are condemned to get back, maybe for a panel discussion or another point for specific item topics.
Avec plaisir.
Oh, and if I could summarize it, let's say in 3 points, if we have to give a message to the startup, what would be 3 major points in a bullet point like that? It's a bullet shot to say, as you just said.
Well, as I say, I think really think twice before accessing the investors, because you have to really take your venture into your hands like a prison and review it and analyze it from all the different perspectives and facets. And you must be really convinced that all items have been completely addressed. And once you have that, you can go to the market. And second, I think, is persistence, because obviously you have to learn to take no for an answer. And normally when investors tell you no for an answer, it's not because they want to waste your time, because they would much rather say yes and invest in you so that they could make money. If they say no, obviously they are missing an opportunity and they're wasting some time. But that should tell you that the no is a component that indicates that there's some red flags into your system, or something has not been completely and thoroughly addressed. I would say this is what I would like to share with the entrepreneurs, especially the younger ones and the smaller ones.
Yeah.
But I don't want to take any more of your time.
No, Giampaolo, thank you very much for your time. We appreciate your experience feedback. I think the investor community is going to be great, and I'm happy to see this. I'm going to release the video or so and put some bullet points to share on LinkedIn because I like it. I'm from the startup and so on, and I'm really aware what you're saying. So for me, it's crystal clear, and I like it because it's when I hear you, I hear my experience. Of course, I might say my experience is shorter than yours, but it's really important to share the experience, and I hope one day to get back and a panel discussion and organize this with you. Thank you very much for that.
Very good. Absolutely. Thanks, everyone.